about using tax credit carryovers, how you can use those. I understand that they're separated by, they come from earned income and you can only then use them having to do with income, or they come from a passive, if I've got this right, or they come from a passive source and you can only use it for the tax on a passive source. But how do you go about, do you have to be in a lower tax environment in order to use them?
What country are you in?
I'm in Germany.
Yeah, so Germany, UK, Spain, these kind of countries, they're always higher than the US, it seems to me. And you always get these excess credit that just sit there and can't be used.
Well, what if I moved to a tax environment? What if I moved to a tax environment that was lower for whatever reason? Either it was naturally lower because it was Singapore, or it was artificially lowered like Portugal. Could I use them then?
In both those situations, then those would start to be used up.
If I didn't have, let's say I'm in a lower tax country, but I don't have earned, no, I don't have earned income, but I have income, ordinary income that might be coming from capital gains, dividends, rentals, whatever. I could use, that would still be in the active category, correct?
Well, the rentals is active, potentially not. Capital gains or the dividends or anything like that, that's all passive.
Oh, okay. So that means if I'm looking at my tax picture in different locations in retirement, a lower tax environment would allow me to use 10 years of built up tax credits.
Potentially, yes.
Okay.
Yep.
And I read in a book that some people in foreign countries should not claim the foreign earned income exclusion and the housing exclusion, but should go straight to the tax credits to get the highest amount if you're going to be over the foreign earned income exclusion. I'm just wondering, how does that make sense?
Well, sometimes in both environments, kind of depend on the level of your income, etc. But sometimes either method would result in zero tax due. But because if you think about your tax return, let's just say you make $120,000 in earned income. You have now an exclusion of $120,000 plus 12,000 standard deductions. So you have basically zero on this total income line on your tax return, which means you cannot fund an IRA. You don't have any earned income on that total income line. So it kind of can prevent that. If you use this foreign tax paid method, then you have a tax, you have 120,000 on the wages line or on the self-employed line, business line, and you end up with 120,000 in total income line. And then it goes to page 2 and you have a US tax gets calculated. So you have earned income in that situation. In that situation, you pay the U.S. tax due with the foreign tax already paid.
A full foreign tax, not using foreign earned income exclusion at all in the second example, correct?
Right. Now, if you move overseas and you just decide to use this foreign tax paid method and never use the exclusion, you're fine. But if you moved overseas and you use the exclusion first, and then you make a move using your foreign tax paid, which could be totally legit if you live in Germany, that's a 5-year election. So if you do it now and then you move to Singapore in 2 years, you're kind of screwed up then, because Singapore, you're paying 16%. And if you use the exclusion, you would just have no tax due on your U.S. tax return. But if you were on this foreign tax method, you'd have to pay up to your U.S. rate after 16 you already paid in Singapore.
Right. I notice on my tax returns, the foreign earned income exclusion has always been used.
If you went to your tax guy and you said, hey, I never fund an IRA, but I want to fund an IRA, and he would say, well, you don't have any earned income, but say, yeah, but I could go on this foreign tax paid method, then I would have some earned income. The way it works is the $120,000 would be divided by the 145,000, and that fraction would be times the foreign German tax you paid already, and that would be disregarded. The extra percent that of 120 divided by the 145 would still be allowed to be used.
Okay. Good.
Yep. So
tax credits. That's on tax credits.
Yep.